Hello everyone, in this video I'm going to be going over ranges, in particular starts of ranges, identifying a range in total, range breaks, fake outs and rotations, and using a bit of order flow as well within all of that. So to begin with, a range typically forms, at least from my experience, after a significant piece of volatility has occurred. You will get the market cooling off for extended periods of time, generating further positions to then trap in one way or another. So if we just go over to the 4 hour here, I'll move this out of my way. I've got something on my screen. You can see here, for example, we've had this extended piece of volatility where price sees a move to the upside. Now you've got this sideways price action, and very similar in most directions where you'll see a volatile move. Okay, a volatile move, and then if we just bring this along here, you then have your sideways piece of price action. So that is generally where they form in terms of like how a range generally starts is after a piece of volatile price action. Same here, volatile moves sideways. That is even defined as a range. Now, defining a range in itself, I like to look at it very simply. And again, none of the stuff I'm talking you through here is going to be like, it's very mechanical in that sense. You know, it's nothing is fixed, and ranges are discretionary in the sense of how you identify one, etc. I'm just talking you through how I do it myself and how I go about it in my day trading if I'm looking at them. So if we're looking at a 30-minute, I always like to see, for example, where can price action be seen to move really fast if a level is lost. So this low, for example, down here, even if there is no touches to this level, to be honest, because most people that I generally see talk about trading and ranges, they go, there has to be a set of identified touch points. Yes, sure, that's the way other people look at it. For me, I'm also really interested in where can price be seen to move really fast, and therefore I can anticipate the first reaction of a potential range low. So for example, in this case here, this is a potential range low, because if this level is lost, I'll be looking really for a much further move down. But if it can hold above here, then we can be looking for further range continuation from that aspect there. So from the beginning, I'm really identifying, okay, resting low here, especially with you got 1, 2, 3, 4 lows resting, where there could be resting liquidity to see, you know, if these are all taken, you could see a bounce there, therefore kind of playing to the idea that this is a potential range low. The range high in this case, a little less well defined. Obviously you have this high here, but I would say you had one failed attempt at it here where you had this generated liquidity here as well. Okay, so you had 2 stops here, another one here. That generated enough time to have some liquidity up there. It took some traders out, and then now we're seeing this rotation back into the range. So I'm kind of classifying this as an extension out of the range, like a range rotation or fake break in that case. Right, so that hopefully understands how a range is formed, identifying highs and lows. And the most important thing for me is identifying, you know, where can price be seen to move fast, and then a break upon that is a confirmed break of the range. Okay, so hopefully that makes sense. Now, range breaks, okay, so for example, if this range was to break, okay, to like, let's say we're going to see a massive move to the upside from here. From my opinion, and from the way I've traded ranges, especially with using the order flow and etc., it will be coming from a squeeze in positions, meaning if price was to move up, it would be from, you know, too many short positions within this range, and if price was to move down, it's from too many long positions within this range. You can obviously use XO charts, so if we just head over to XO here, right, you can be using XO charts to define this. So you've obviously got this sideways piece of price action here. There's multiple ways you can go about identifying those positions, you know, which side is positioned heavily. For example, what I would do is, let's go to D bars here, and we can go to full data, okay, or visible range. And what this is doing now is we can see, okay, how the delta starts off here, so from at the start of the range, and where it is now. Right now, to be honest, it's fairly neutral. And again, you can use the open interest as well, so it starts here, and that is also, it is slightly increased if anything, but there's been a lot of, you know, fall off in positions from here, from this drop here, and so on and so forth. So I wouldn't say at this very stage there is overextension on either side of the market, especially at least within this current range. Maybe from before, but I'm talking about this current range in itself. But generally, for example, if we were going to see a massive increase in new short positions here, so like massive open interest increase, massive decline in delta, then you'd be looking for, I would personally be favoring a move to the upside, especially if it was able to hold above 53k. If you obviously see over leveraged long positions, or not even over leveraged, you know, just looking at the general consensus, in my opinion, what are long positions doing from the start of the range onwards? What are they doing? And if there's a lot of new longs coming in, well, then I would say if you know, I'd be hesitant on long on a move down to the range lows, because I'd be thinking that those long positions could get put, start flushing the market further to the downside. Okay, so that's generally how I'd look at range breaks, and they generally do come from squeezes, although inherently people always say new money coming into the market is bullish, etc. Yes, it is, but from my experience, again, the biggest and unforgiving moves really do come from people becoming squeezed and the market squeezing. It really, if we're looking at it in this case, the market would literally just rip from here, and there would be really no looking back in that case from how I've seen that. So hopefully that makes sense on that front. Now, like range rotation, so general rotations where I'm actually trading the moves down here, up at the highs, just the first taps of where price can be seen to have resting liquidity at the absolute highs and lows of the range. Absolute, so not internal, at the absolute highs and lows. That will generally be formed from, and I'll show you on the order flow in a second, liquidations, internal, more local liquidations, aggressive people coming in to try and buy a breakout or a fake out, etc., coming into the market, or on-side traders, just people trying to, in this case here, for example, at this high here, I wouldn't say there was a massive, aggressive amount of people actually trying to buy this specific breakout here. I wouldn't say that, and I'm going to talk you through exactly how we can identify that in a second. But more so, there was actually shorts driving price back into the range to then offer, this move towards the downside, even though it's a very slight move down to the downside, new shorts opening in that sense. Alongside that, obviously you can get market order bubbles, showing aggressiveness. Again, all of this stuff is on the website where I cover, you can just grab a link to this indicator, it's all free. But yeah, so we just head over to XO charts very briefly. You can see that, same way we have, if we just bring this up, actually I won't bring this up, we'll just delete this. Okay, so I'm going to have this line, and I'm going to draw it at the very highs, okay, where you have the range highs that we're saying is there. Now, upon the break of this range, you can see as delta's increasing, okay, open interest is decreasing. This is shorts closing, okay, upon this break of the range. You then have this move here, which is more important to me, where you then see, I'm always more interested in open interest increasing. So open interest increasing, new shorts coming in here. Now, you might be thinking they could be continued to get squeezed, but they don't. They're actually playing the market on side. The market moves down, and these shorts are on side. What does that mean? Well, that means that these shorts basically were driving price back into this range, at least from my opinion, at least. And you can be using that as your invalidation. So in this case, rather than being like, there was a lot of new breakout longs at the high, I wouldn't be saying that. I would personally be saying, well, there's definitely a bit more aggressive shorting at the highs, who are, potentially bigger players trying to push the market back into range, and you can be trading with them on side at least, because no one really talks about this, where you have on-side traders. Just moving back to trading view quickly, and I am kind of going off the whim here in my recording in this case, but for example, not every move is a fake out, to the other side of the range. You will get people, traders that bring price back into range are mainly new longs opening. So sometimes you'll have new longs opening to push price back into range, who you can then play off those new longs, or in the reverse, as we just saw, new shorts coming in here, and we can play off those new shorts. Okay, so it's two different ways to be looking at that. In terms of trading, like those different range rotations is really, really interesting. Obviously, like I said as well, you can be looking, if we just turn on the rect, people coming and getting liquidated upon the first initial move above the highs. That makes sense. And at the lows as well. It both, you can be looking at all types of aggressive nature, but more importantly, upon these range rotations that you want to be trading, especially on mini fake outs and stuff. Sometimes you will get, new shorts or new longs entering at the highs of the range, or new shorts at lows, and that obviously will also require, allow you to take a trade. I'm just saying not every occasion is like that, and you don't have to be always looking for trap traders, although they do offer, the better opportunities, in my opinion, once they offer a reclaim back into the range. That makes a lot of sense. Like I said, again, on trading view, there are a few things you can be looking at. Volume spikes, again, the coloring of the candles, again, the market order bubbles for aggressiveness, and so on and so forth. Those few things are really, really important. Obviously, internally of the range, you can have a lot of different moves going on. For me, I believe it was last week, or beginning of February, really, we had this range going on, and it was all internal. You had like this really, obviously you've had these ranges here. Now we're breaking up and you're ranging for a small amount of time. Even here, I'll be really just going like volatile move to the upside, high, and this is your low, and then also you've got like these range low taps before then a considerable break. Okay, and when price obviously revisits some of these ranges, by the way, you can be using their volume profile to decipher, good. For example, in this case, you can pick this out and go, okay, the POC's here. and using those for really key, nice POIs or levels of interest in that case. But when you're within a range and you're confined within a range, like I think I had a really, really, really well performing start to this year, still to this far. You know, even like we're not even 2 months in, I'm probably up around 20 plus R to this day. You know, I'm not going to overdo it in that sense, but more so to do with this internal range movement where I was getting a lot of my trades trading internal liquidity of a range. So just going over this now, when you have a range here, for example, you have obviously absolute extremes, and most people can be trading that, but you also get like these internal movements, right? And these for me will also offer trades, even though that was drawn horribly. These, for example, you can take a short trade off of these two highs here. They could get taken, and that could offer a small rotation, you know, and those type of trades also offer me different, you know, different types of setups, and those, you know, require a lot more mechanicalism from myself, you know, looking for high hit rate levels, etc. But the overall concept of the ranges, hopefully this has been making sense to you on that front. I will say there is an XOCharts course I've released again for those, and you get 3 months of XOCharts plus lifetime coin market manager. It's all free to the extent where you just deposit $500, take one trade, and, you know, submit your UID for WooX, and you get, you know, everything for free on that front. So I really want to create a deal that I think wouldn't just be money grabbing, and I hope, you know, it makes a lot of sense to all of you to do that if you want to get into XOCharts, learn about order flow, etc. And if you do have any queries, do let me know. But hopefully this has made a lot of sense to you about ranges, trading rotations, trading fake outs, breakouts, and going on from there. You can really look at this. And if you have any questions or further recommendations for me to cover, you know, DM me on Twitter, X, formerly, you know, there, or in the comments below. And also there's a lot of different threads, etc., that I've been covering on X as well, that you can be going over and listening to from there. So yeah, hopefully it makes a lot of sense. Thank you all for watching.